Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. So, last week we had the incredible news of Saudi Arabia potentially breaking away from the petrodollar. And now this week we had major news out of one of the Japan's largest bank, their fifth largest bank, that we'll get into in just a second. And basically, that news was that they are going to dump 63 billion in U.S. government and some European government bonds. Now, this follows the trend of the Japanese central bank, the Japanese government, basically reducing their bond purchases. And I need everyone to kind of bear with me a little bit as I take us through this story. But this is a big thing, and it's going to become a big problem for the United States Treasury, and I'll lead to that as we get there to the end. But what I want to do is just take everyone through a couple articles here and say, like, okay, how did we kind of get to where we're at here? So first article I want to take everybody to. So this is an article from CNBC, and this is from back in April. This is on April 24th, and it basically says, Japanese remain net sellers of foreign bonds. So there are great expectations that Japanese companies flooded with liquidity will pour some of it into foreign bond markets, but latest capital flow data published on Thursday tell a different story. Japanese institutions were net sellers of foreign bonds for a sixth straight week, selling 862.6 billion yen, which was 8.7 billion, in overseas debt for the week ended April 20th, according to weekly data from the Ministry of Finance, more than double the net 331.9 billion in the previous week. The country's latest 1.4 trillion monetary stimulus program has raised hopes among investors that Japanese liquidity will now be used to buy foreign assets like bonds, but this has yet to happen in a big way. And a large driver behind this, according to market watchers, is Japanese firms taking advantage of the recent fall in U.S. Treasury yields, which move in the opposite direction to prices, to sell U.S. bonds and repatriate funds back home. The steep depreciation in yen also makes it a right time. They are making gains from the fact that bond prices are picking up with the yen depreciating. The profit there is too good to turn down, said Evan Lucas, who's a market strategist at IG Markets, told CNBC. However, it may not be long before Japanese institutions turn into net buyers of foreign bonds. And this person who sees a potential shift taking place mid-May. Yeah, that didn't materialize. The Bank of Japan, BOJ, is set to purchase around 70% of government bonds issued each month, driving yields lower and crowding out private sector investors. Japanese banks, insurers, and pension funds have around 3/4 of their securities portfolios in domestic debt, according to Deutsche Bank. He expects the primary destinations for Japanese liquidity will be U.S. Treasuries due to their low risk nature and liquidity of the market, as well as Australia's AAA rated government bonds. So we got a couple things there. So back in April, basically Japanese were selling off their bonds, and they were taking advantage of the lower Treasury yield to try to dump some of the basically taking a bath, as it were, on some of these bonds, and they were trying to dump some of this stuff. So now let's get here. This is June 13th. So this is just from a couple days ago. So this is Bank of Japan to scale back government bond purchases at policy tightening move. The Bank of Japan will scale back on its monthly sovereign bond purchases, helping banks align their lending and investment strategy with the central bank's moves to normalize monetary policy. The BOJ will announce details of the reduction of its monthly Japanese government bond, JGB, purchases by the end of July. The decision is being made to ensure that long-term interest rates would be formed more freely in the financial market, the central bank said June 14th after its two-day policy review meeting. We will hear opinions from market participants and will pursue it properly, BOJ Governor Kazuo Ueda said at a press conference after the meeting. The BOJ currently purchases nearly $6 trillion in JGBs a month. Gains to bank, the central bank's decision would help increase long-term rates gradually, tilting in favor of banks. Kiyuchi expects a gradual increase in rates to support banks' lendings. By gradually raising rates, the BOJ will aim to avoid any shocks to the economy and limit unrealized losses on banks' JJB holdings. The Bank of Japan is under growing pressure to tighten its monetary policy to halt the yen's sharp fall. The US dollar has gained 11.3% against the Japanese yen since the start of the year, making imports costlier. The central bank is expected to tighten further after it abandoned its negative interest rates policy earlier this year, combined with a possible rate cut by the U.S. Federal Reserve later this year. The BOJ's shift away from the ultra-loose monetary policy settings will narrow the gulf between U.S. and Japanese interest rates. The BOJ is likely to diverge from other global central banks, which are widely expected to start reducing rates after they have greater certainty that inflation is getting under control. While economists mark down the timing of the Fed's rate cut, they anticipate it will take action later this year. So again, this is very interesting because like I said, other central banks around the world, particularly Canada, just cut its rate. I believe the European Central Bank just cut its rate by 0.25%. So these guys are making small rate cuts right now. The U.S. Fed is thinking about cutting rates a little bit, but has not done it yet. But the Japanese, on the other hand, are looking to raise rates as they just came out of a basically an almost 10-year negative interest rate environment. And I did an episode on that a few months back. And now let's get to the big news here. So, because I wanted to set the stage here. So basically, you could see that the Japanese government is reducing their bond purchases. They're trying to help their banks with their unrealized losses that they currently have on their bond portfolios. And that's what brings us to the big news here. And this is an article from Yahoo Finance called "Japan's Century-Old Bank Sends Warning to the World on Higher for Longer Rates." And this is if I'm saying this correctly, Norinchukin's, they just call this, what do they call this for short? They call it Nochu. Yeah, Nochu Bank is how it's known in short. So Nochu or Nochu, no Nacho, Noch, Norinchukin's. I'll just say Norinchukin's, Norinchukin's investment portfolio. So we're looking at a chart here, basically made up of bonds, stocks, and then credit and other facilities. And you can see here that they have a huge bond portfolio right here. I mean, as far as yen goes, I mean, over half their, portfolio is made up of bonds, and is just, it's a huge bond portfolio. So let's go in here. So now this is the fifth largest bank in Japan. And here's another interesting thing. It was known as Japan's CLO, collateralized loan obligation whale, a $357 billion asset investing giant with seemingly insatiable appetite for yield in an era of rock bottom interest rates. Now, anybody who's followed my Lords of Easy Money series will know all about the CLO and how during the ZERP and the quantitative easing policies done by the Fed, they created a reach for yield. And basically banks like this bank in Japan were buying up the CLOs like there's no tomorrow. The problem is that model is now completely broken because the Fed turned the markets on its head to create and push ZERP and push quantitative easing. And now that that's all done and they have basically turned back to a normal interest rate environment, that model is broken. Yet you still see a lot of these banks trying to grow that loan portfolio, still trying to grasp that, and it's a problem. It's a huge problem. We'll get into that in a second. So let's get down to it. So now, Norinchukin Bank has become one of the largest casualties of an entirely different financial world, where higher for longer borrowing costs are exacting a painful toll on the market's weakest hands. The agricultural bank surprised the market this week by saying it would sell $63 billion of low-yielding U.S. and European government bonds that had become unprofitable to hold after the firm's shorter-term funding costs jump. The unlisted firm warned that losses this financial year may swell to 1.5 trillion yen, $9.5 billion. So this is a $357 billion asset bank. This is not like, this is like, if you compare this to say like JP Morgan, it's got, $3 trillion in assets and does quarterly profit of, what is it, 20 something, $25 billion in quarterly profit. Yeah, these guys are still would be considered in the US a very large regional bank, but obviously a $9.5 billion loss is enormous. Triple an estimate made less than a month ago. Triple more than an estimate made less than a month ago. And I would remind you that what happened to Signature Bank and Silicon Valley Bank, what happened was their bond losses wiped out their capital. And that's exactly what could happen here to this bank. The Norinchukin and the Japanese government has expressed confidence in the bank's ability to weather the losses. In other words, everything is fine. Everything's okay here. There's nothing to see here, nothing to worry about. The episode is a reminder, wait for it, here we go, of the dangers still lurking in the financial system 15 months after the collapse of SVB Financial Group, Silicon Valley Bank. Signals from the Federal Reserve and other central banks that are in no rush to cut rates have caught out many investors betting on more aggressive moves. That's created a tricky landscape, you could say that, for institutions which piled into U.S. and European sovereign bonds on the expectation that falling rates would spark a debt rally after 2 years of decline. So the bank is now overhauling its portfolio, selling off a third of its sovereign holdings and shifting to other types of assets, including collateralized loan obligations and domestic and overseas bonds. And this is where I have an issue. I don't think they're going to be able to hide from their problems, so to speak, by diving into collateral, by diving into CLOs. I think that's a losing proposition. I think that is going to end up basically just adding more risk to their, I think that's just going to add up just adding more risk there. It is surprising that they didn't hedge interest rate risk. Yes, I think that's a good, Asian sovereign strategist at Robeco Group in Singapore. It may have been that they had high conviction regarding Fed and ECB cuts and initially thought it was just a temporary delay. And again, same thing with SVB and Signature Bank. That was one of the main questions that came out of those bank failures last year, is why didn't they hedge their interest rate risk? I've done other episodes where I've talked about hedging. I did. If you guys go and look at the 2 interviews that I did with Bob Newman from Chatham Financial, they do all these great hedging strategies for banks. Go check out those interviews that I did with Bob. Basically, this is what we talk about. Why didn't banks hedge some of this risk? And let's see here. Let's keep going here. Is it the only bank? So they're not the only bank basically suffering from wrong way bets on rates. SVB collapsed. Got that. Okay. More recently, the higher for longer rates have led to paper losses in many banks and fund managers. Yes, they have. The Fed has yet to move this year, even though the market was pricing in 150 basis points of cuts as recently as December. U.S. banks had $516 billion of unrealized losses in their securities portfolios at the end of March, according to regulators. While Norinchukin has a much lower risk of a run on deposits, giving its stable farming cooperative clients, it's facing growing questions about how it mismanaged the debt portfolio and why the projected losses ballooned so quickly. The bank's spreads widened Wednesday on the news of its deeper losses, while Japan's top government spokesperson said the bank's health is secure. I was surprised, to be honest, by the size of the potential losses, said Uochi, head of finance and general affairs at Iwate Prefectural Credit Federation of Agricultural Cooperatives, a regional body that invests deposits for local cooperatives. Basically, that's like pension funds. Think of that as like pension funds. If the bank were to request more funds to match its deeper losses, that would be a huge shock. Adding, he sees this as an unlikely possibility. Norinchukin said last month they will raise 1.2 trillion yen from the agricultural and other cooperatives that own it. Again, you're getting back into the same thing. Like, you're hearing this is the same playbook with a lot of these failures. Everything's fine. Don't worry. Oh, we're going to go out and raise money. No, we have this stable deposits. Nobody's going to run on us. And then they go back to say, oh, the bank had problems in 2009 and it rattled markets, whatever, blah, blah, blah. And here we go. In place of interest risk, the bank will be taking on credit risk if it adds collateralized loan obligations or corporate bonds. Yes, absolutely. So the firm held 7 trillion yen in CLOs as of March. The firm has also said it is mulling investments in Japanese government bonds as it seeks to rebuild its securities portfolio. Yeah, I mean, I don't get the okay, we're gonna reduce our bond exposure to reduce our bond risk, but then we're gonna add credit exposure by beefing up and buying more CLOs at a time when I don't think it's a great time to be necessarily buying CLOs. But anyway, and then it kind of wraps up here at the end. The chief investment officer says, yeah, we're gonna do a better job, and I got to accept responsibility and all this and that, whatever. Okay. But I think like this just goes to show you that like this whole issue of unrealized losses on the bond portfolio. This is hitting banks all across the world. And this is huge. And now I want to get to what I started with at the very beginning. How does this play in with the US Treasury? Why is this so bad with the US Treasury? Japan is behind China. Japan is the second largest purchaser of US treasuries and US bonds. Okay. It basically goes, US government, China, and then Japan. Japan and China have dramatically been cutting back on their purchases of our bonds. Okay. Why is that a problem? Well, it's a problem because this is a time when our spending has been absolutely out of control and we have to issue the debt in order to sustain and continue that spending. And if we can't sell the debt, that's a huge problem for our monetary system. And the other thing is it becomes a risk reward equation, right? Like in other words, the greater the risk, the higher the return. So in order to entice China and Japan to start buying those treasuries and bonds again, you might have to dramatically increase the rates. And especially on longer term. So what the Treasury has been doing right now is that they have been buying up all the shorter term, higher paying bonds, and they've been using the cash account at the Treasury to do that. And that's what's kept the yield curve inverted. That's what's kept the higher end of the curve lower. But the problem is the U.S. Treasury is not going to be able to just continue doing that forever. At some point, they're going to bleed the cash account down, and then they're going to have to let the market balance. And if the yield curve reverts back to a positive position, that's not going to be a good thing. And you're actually going to see rates go up. When Jamie Dimon was talking about rates going up, that's what he was talking about. He was basically saying that, the Treasury is not going to be able to play this game forever. And sooner or later, with China and Japan sitting on the sidelines, not reducing their bond purchases, that's going to put a lot more pressure on the Treasury to sell debt to continue to fund our absurd government spending that's out there. And that's going to drive rates up at some point. So you are going to see, the 5-year yield, the 10-year yield, the 30-year yield. You are going to see these rates eventually begin to go up as the yield curve reverts back to a positive territory. And that's not going to be a good day. That's not going to be a good day when that happens. But again, this is, huge news. Again, I'm going to keep a very close eye on this bank. I think this bank could have major trouble here in the next few months. We'll have to see. We'll have to see how this plays out. Hopefully they can get it, kind of stabilize it with the sale, the dumping of these bonds in their portfolio. But we'll have to see. But again, this is not good news for this bank in Japan. This is not good news for, obviously, if this bank goes down, that's going to be a big shock to the Japanese economy, the Japanese market, and it'll send ripple waves through the global economy, and it'll basically, and it'll like I said, it'll hurt us. Our markets, I think, would react very negatively because that just means that the decline in bond purchases from Japan will just steepen. So we'll see. Like I said, we'll continue to monitor and see what happened. But man, it just seems like every week there's just these huge stories that are coming out here the last couple weeks. So good for me, because it gives me something to talk about with you guys. So good stuff. But if you like this episode, please make sure to like, share, and subscribe. Leave your comments down below. I would love to hear people's comments on this one in particular. And remember, we are on YouTube, Rumble, and all major podcast platforms. And I will see you all real soon. Don't forget to check out some of the other episodes on the channel. Weekly banking update coming in this weekend. Make sure to check that out. And I will see everybody again real soon. Thanks a lot.